June 12, 2026. SpaceX opens for trading on Nasdaq under the ticker SPCX at $135 per share. The company has raised $75 billion in the largest initial public offering in the history of financial markets. For context, the previous record was Saudi Aramco in 2019, which raised approximately $25 billion. SpaceX raised 3 times that in a single day. The company's valuation at listing, $1.77 trillion. That makes it, as of today, the 8th largest public company in the world, larger than Berkshire Hathaway, larger than Walmart, larger than JP Morgan Chase. This video is going to break down exactly what you are looking at: the business, the financials, the valuation math, what public shareholders actually own, and the one question nobody is asking loudly enough. Before the valuation math, before the investment case, you need to understand what you are actually buying. Because SpaceX is not one business. It is 3 businesses consolidated into one company with 3 very different financial profiles. Business 1, Connectivity, which is Starlink. SpaceX's satellite internet service had 10.3 million subscribers as of March 2026, operating across 164 countries. In 2025, it generated $11.4 billion in revenue and $4.4 billion in operating profit. Starlink is the only profitable segment in the company. It is, functionally, the engine that makes everything else possible. Business 2, Space, which is the rocket launch business. Falcon 9, Falcon Heavy, and the Dragon crew capsule. In 2025, the space segment generated $4 billion in revenue. SpaceX handles approximately 85% of all orbital launches globally. Starship, the next-generation vehicle that could transform the economics of the entire space industry, is in testing and is expected to begin commercial payload operations later this year. Business 3, SpaceXAI, which includes the XAI artificial intelligence operations that SpaceX acquired in February 2026. In 2025, the AI segment generated $3.2 billion in revenue. It also posted a $6.4 billion operating loss. In Q1 2026 alone, the AI segment burned $2.5 billion. Put simply, Starlink pays the bills. XAI burns them. The launch business sits between the two, strategically critical but capital-intensive. The headline financial story is deliberately confusing, and I want to make it clear. SpaceX reported $18.674 billion in total revenue for full year 2025. That is a 33% increase over the prior year. The company reported a GAAP net loss of $4.937 billion. Yet simultaneously, adjusted EBITDA reached $6.584 billion, with $24.7 billion in cash on hand. How can a company generate $6.5 billion in EBITDA and still lose nearly $5 billion on a GAAP basis? The answer is primarily 3 things. First, XAI, the AI segment, lost $6.4 billion in operations in 2025. That single segment is the primary reason the entire consolidated company reports a GAAP loss. Second, Starship development. SpaceX is spending approximately $3 billion per year on R&D for Starship, which is not yet in commercial operation. Third, stock-based compensation and satellite depreciation, significant non-cash charges that reduce reported earnings but do not represent cash leaving the company. The critical analytical point: strip out the XAI segment and the legacy SpaceX business. Starlink plus the launch operations is profitable on both an operating and EBITDA basis. You are buying a profitable satellite internet company bundled with a loss-making AI startup and a rocket company building the most capable launch vehicle in history. Whether the price reflects that bundle accurately is the core of the investment debate. Starlink is the reason this IPO is plausible at a $1.77 trillion valuation. Starlink had 2.3 million subscribers in 2023, 4.4 million in 2024, 8.9 million by end of 2025, and 10.3 million as of Q1 2026. The service is available in 164 countries, covers maritime routes, aviation, and a growing government and defense tier. SpaceX has deployed over 9,600 satellites to power it. In 2025, Starlink generated $11.4 billion in revenue and $4.4 billion in operating profit. That is a 49% revenue growth rate and a 120% growth rate in operating income year-over-year. On an adjusted EBITDA basis, the connectivity segment generated $7.2 billion. Starlink is already one of the most profitable telecoms businesses in the world, measured by margin. There is a risk in the subscriber economics that needs to be flagged. Average revenue per user has been declining, from $99 per month in 2023 to $81 in 2025 to $66 per month in Q1 2026. SpaceX is growing its subscriber base by lowering prices and reaching less wealthy markets. More subscribers, lower average ticket. The math still works today because volume growth is outpacing ARPU decline. Whether it continues to work as the addressable market expands into lower-income geographies is the key long-term question for the core business. In February 2026, SpaceX acquired XAI, Elon Musk's artificial intelligence company, which operates the Grok chatbot and large-scale AI model infrastructure. The acquisition consolidated XAI's operations, revenue, and losses onto SpaceX's balance sheet. The XAI segment generated $3.2 billion in revenue in 2025, but generated a $6.4 billion operating loss. XAI's capital expenditure in 2025 was approximately $12.7 billion, and in Q1 2026 alone, the AI segment burned $2.5 billion. The accumulated AI-related losses are the primary driver of SpaceX's consolidated net loss. XAI is competing directly against OpenAI, Google DeepMind, Meta AI, Microsoft Azure, and Amazon Web Services, the 5 best-funded AI organizations in the world. The competitive position of Grok relative to GPT-4o, Gemini, and Claude is contested. These losses are now being funded, in part, by the capital raised in this IPO. AI could be the long-term value driver that justifies the entire IPO valuation. SpaceX has disclosed plans for space-based data centers as early as 2028. But it is speculative, early stage, and is currently costing billions per quarter to pursue. $1.77 trillion for a company losing $5 billion a year. How does that math work? At $1.77 trillion enterprise value and $6.6 billion in adjusted EBITDA, SpaceX trades at approximately 268 times EBITDA. The average S&P 500 company trades at around 15 times. Even high-growth SaaS companies rarely sustain multiples above 60. 268 times is not a valuation based on current earnings. It is a bet on future businesses that do not yet exist at scale. Most serious analysts put standalone Starlink value in the $400 to $600 billion range. The remaining $1 trillion plus is the market assigning option value to Starship commercial operations, the space economy, lunar infrastructure, and XAI's potential. That is not necessarily irrational. The space economy is estimated at over $1 trillion by 2040. The final risk, public float. Only about 5% of SpaceX's total shares will be available for trading following the IPO. This creates an illiquid market where large price swings are possible on relatively small order flows. Here is the most important sentence in this entire video, and it is buried in the prospectus. Elon Musk owns approximately 42% of SpaceX's equity. He controls approximately 82% of its voting power through a dual-class share structure. SpaceX's public offering consists entirely of Class A shares, each carrying 1 vote, while Musk holds Class B shares, each carrying 10 votes. The entire public shareholder base will collectively control less than 18% of the company's voting power, regardless of how much equity they purchase. The California Public Employees Retirement System, the New York State Comptroller, and the New York City Comptroller jointly oppose the structure, calling Musk's position essentially unfireable without his own consent. What public investors are actually buying is economic exposure to SpaceX's cash flows, the right to share in future dividends and sell their shares at market price. They are not buying governance rights or board influence, though this structure is not unique to SpaceX. Amazon, Alphabet, and Meta all have dual-class structures as well. SpaceX has targeted approximately 30% of the total offering for retail investors, roughly $22.5 billion allocated through Charles Schwab, Fidelity, Robinhood, SoFi, and E-Trade. The typical IPO allocates 5 to 10% to retail investors, but SpaceX is offering 3 to 6 times the normal retail allocation. The price is fixed at $135 per share. Rather than a traditional book-building process, SpaceX announced the price before the roadshow even concluded. You have 3 choices: take it at $135, do not participate, or request your allocation through your brokerage before market open. Understand that IPO allocations for popular deals are often not fully filled, and be aware that first-day trading for large IPOs frequently involves significant volatility. The bull case: SpaceX is the most consequential infrastructure company of this century. Starlink has a defensible near-monopoly on satellite broadband, growing at 50% per year. The launch business controls 85% of global orbital launches. The AI investment is high risk, but space-based data centers could be enormous. Elon Musk has a consistent track record of doing things experts said were impossible. The bear case: you are paying 268 times EBITDA for a company whose only profitable segment faces declining average revenue per user. The largest segment burns $2.5 billion per quarter. Long-term debt is $29 billion and accumulated deficit is $41 billion. You have no governance rights. You depend entirely on one person's continued ability and willingness to execute, with essentially no board oversight. This is not a conventional stock purchase. It is a structured bet on whether one person can rebuild the global internet from space, dominate the emerging AI race, colonize Mars, and deliver shareholder returns across a time horizon measured in decades. That bet might be right. It might not. But it is the bet you are making at $135 per share. Do your own math. If this gave you a clearer picture of the SpaceX IPO, hit like and subscribe. In the next video, SPCX versus Tesla: if you can only own one Musk stock, which one gives you better exposure to the next decade? See you there.